Welcome to Bergonomics, demystifying economics with Ross McDowell.
Welcome to the Bergonomics podcast, where we demystify the economics affecting your life. I'm your host, Ross McDowell, and we're here in the library at the Royal Brighton Yacht Club overlooking beautiful Port Phillip Bay. Lean back, close your eyes and think about all the interest you pay in your lifetime on your mortgage, personal loans, lease payments and credit cards. Take your home loan, for example. If you borrowed $1 million at 4.2% over 30 years, you will have paid $760,000 in interest. But what if you became an interest rate clairvoyant and could predict interest rates into the future? If you knew rates were going to rise, you might decide to increase your debt repayments, reducing your interest bill by hundreds of thousands of dollars over the term of the loan. In today's Bergonomics podcast, we're going to discuss a group of people who many believe can predict interest rates. Sometimes seen as a controversial group, they trade Australian financial instruments worth $1.6 trillion each year. They are a group who remain largely nameless and in the shadows. You rarely see them in the media. To talk about this mysterious group of financial traders, I have with me the gentleman in charge of global economic and financial forecasting for the National Australia Bank. It's their chief economist, Mr. Oster. Prior to joining the NAB in 1992, Alan was a senior advisor with Australia's Federal Treasury and has also spent 4 years in Paris with Australia's delegation to the OECD. Alan, welcome to the Bergonomics podcast.
Thank you, Ross. Pleasure to be here.
This mysterious group I'm describing are bond traders. Now, as soon as I mention the word bonds, many people will want to fall asleep, as they believe the concept of a bond is hard to understand. Before we explain the concept of bonds and their importance to interest rates, we need to emphasise just how important interest rates are to Australian households and our economy. Australia has the second highest level of household debt in the world. I think the first is Switzerland. So interest rates and therefore mortgage rate increases have a dramatic effect on families' spending and their standard of living. Household spending is a contributor to inflation and employment, and the Reserve Bank recently increased its cash rate quite dramatically. But ask 10 economists where interest rates will be in 1, 3, 5 or 10 years' time, and you will get a variety of answers. Alan, why are interest rates so hard to predict?
Basically, what you're trying to do is you're trying to figure out what's happening to the economy. And then you look at the various policy measures you can use. There's normally three groups. One is structural policy, so that's basically trying to make the economy more productive. Second one is fiscal policy, and the third one is monetary policy. And so that's interest rates. And so really, when we're looking at where are interest rates going to go, you need to know, in a lot of ways, what's happening to the economy. And if you like, a 5-year or 10-year bond should really just be an averaging of those next 12 months by 10 years to get us a feel. And then you put a bit of a premium in there because you're never sure exactly what's going to happen. So you have what they call a term premium. In other words, how much will you pay to keep your money locked up for another 10 years? So bond traders are just basically trying to guess where interest rates will be on average over the next 10 years, for which they need to know, is there a recession coming? What's happening to inflation? And so I would also say that whilst economists are not very good at predicting interest rates, and remember there are a lot of economists in central banks, bond traders are, if you look at their historical record, even worse.
Okay, great, because we're going to come to their historical record and how they're going, what their scoreboard is. Now, I'm going to take a massive chance and try and explain a bond using Bergonomics to do it.
Oh, God.
because I know that, as we've said, if you want to put everyone to sleep at a dinner party, just talk about bonds. But here we go, and jump in when I start to stuff it up. Now, a bond is basically a loan with interest payments up until the date of when that loan is repaid. It can be in the public or the private sector. Let's just confine ourselves to government bonds for this one. So let's say I've got $100, and if hamburgers were $10 each, my $100 would buy me 10 hamburgers. Or I could lend the Australian government my $100 by buying an Australian government 10-year bond. The Australian government will pay me $2 every year for 10 years in interest, and then give me back my $100.
Yep.
So we're using simple numbers here.
Yep, that's right.
So they're paying me the equivalent of 2% per year in interest.
Right.
Now that 2%, this is where people get confused, that 2% is called the yield on the bond.
Yep.
And it's calculated on the price that I paid on the bond at that time. So after 10 years, I will have received 10 lots of $2 interest payments and my $100 back, so I'd have $120 in my pocket. So if the hamburger cost $10, then I would then be able to buy 12 hamburgers, 2 more hamburgers than I could buy at the current time with my $100. Am I going okay?
You're going well.
Okay. But let's say after 7 years of owning the bond, inflation erupts. Hamburger prices increase by 20%, and so a hamburger becomes $12 each. So the $120 my government bond will make me after 10 years of ownership will not buy me the 12 hamburgers I was expecting after that time. It's only going to, in fact, buy me 10 hamburgers, the same as what I would have had at the beginning.
Yep.
So I go, well, what's the point of owning this bond? So I'm not happy, so I'm going to sell my bond, but because there's inflation, it's eaten away the value of everything, including, obviously, my bond. And the bond traders come out from the shadows, and they are only going to offer me $89 for my bond, $11 less than I paid for it, which I have to take because that's all it's being offered. But the new owner of the bond, he still gets the $2 being paid by the government. That doesn't change. So that $2 interest payment as a percentage of the $89 that he paid is more than my 2% that I was getting.
Yep.
It's 2.2%, even though it's still the same $2.
Yep.
So it's just an arithmetic calculation.
Yes.
And the higher the percentage, then we say the higher the yield.
Yes.
And I guess that's where people always, they come undone about
Yeah.
yield and percentages. It's just simply a ratio of whatever is the market value of the bond, because the interest amount always remains the same.
Yep.
Okay, so therefore this yield is the percentage number that a lot of people want to say correlates to interest rates and where they're going, up
Yes.
or down.
Yes.
Would you agree with that?
Basically, and you can make, these days you can even buy a bond that will have an inflation adjustment for it. So you can do, and well, that's a bit more complicated, I suppose.
So no, hang on. So what they do? So it's a CPI added to the
Yes.
to the bond.
Yes, and so you do get a feel, is it a real change or is it a nominal change? The other thing that's important in the bond is you're making assumptions about where the cash rate or where the yield's going to be
Yep.
going forward. And if you're worried that there might be a recession, you can see the gap between the current yield that you're going to get for year one
Yes.
versus the year you're going to get in year 10, and you
Yes.
might make an adjustment therefore. So some people then say the difference between the current cash rate and the 10-year bond
Yes.
will give you an indication of whether people are prepared to pay for uncertainty such as a recession.
Okay. So, and that's really the definition of an interest rate is risk.
Yes.
It's just a measurement of risk.
Yeah, exactly.
And that's the reason why a government bond will have a lower interest rate than a commercial bond, because
you should be less risky.
hopefully
The government won't default.
in our government. We're okay. So many economists and financial market operators use the 5, 10-year and the 3-year government bond yields to try and lock on to where they think.
Yeah, inflation or the economy's going.
Okay, and are they doing that because that's the easiest sort of indicator for them to do it, the most independent, easy indicator?
Well, what they're trying to do is they're saying, okay, I can go out, anyone can buy a bond, but I don't want a 2% interest. I want something better than that. And so what I'll do is I'll try and offer you, to use your analogy, $80 for your $100. And then I'll still get my 2% yield, but you know, if I'm getting 80 cents, I'm sort of getting a 4% return. And so that's what they're trying to do. They're trying to maximise what they call fixed interest market returns, and by doing, and what they're really doing is playing with the price of the bond.
Okay. And now they're doing this because they're trying to make a profit.
Yes, exactly. And they're being paid to try and make a profit.
And so it's in their interest to beat you down, basically.
It's in their interests. So the lower the sort of return, the higher the yield sort of thing. It's like an inverse relationship there.
But the yield really is in some ways kind of irrelevant, because they're trying to beat you down on the price they're paying for the bond. The yield's just a calculation.
Well, the other thing is that, you know, if you hold your burgers for 10 years, you will still get your 2% back. So the only reason you'll sell it is if you think, ooh, it not only might go to $80, it might go to 60.
Yeah.
And so that's the sort of, do they know better than everybody else?
Yes.
And their answer is yes, we do. And therefore they make a bet on interest rates, and they make a bet on, where the economy's going.
Yeah. Okay. So let's have a little look at their scoreboard, some of their scoreboard. So if we look at 2019, so if we use, there is the 3-year government bond.
Yeah.
Okay. So 3 years ago, at the start of June this month, 2019, the Reserve Bank cash rate was 1.25%. At the same time, the 3-year government bond, its yield was 0.942%. So in June 2019, the 3-year government bond, which would have been repaid to you this month in 2022, it was predicting that the cash rate today would be 0.942%. So that was, if you want, the bond yield prediction 3 years ago. Now that's not bad, is it? Because if today's cash rate's 0.85%, they're only 0.092% out. That's pretty accurate.
That's accurate, but of course if you trade it a little bit differently, a 3-year bond in 21, after the Reserve Bank decided they'd have yield curve control, so they try and control the 3-year.
So the yield curve, let's explain the yield curve.
So the yield curve is basically the difference as you go from 1 year to 2 years to 3 years to 4 years to 5 years. So what's the gap between the cash at present versus the maturity of the bond?
Yep.
And as you go further out, the yield curve should go higher because there's more uncertainty in it.
Right, so it should go up. So it's just a graph of the yield of the percentage interest rates, and it should go up like a hill. Because
there's more uncertainty, the longer you stay out.
And there's more risk involved.
There's more risk,
But it's not going to be a steep mountain, hopefully. It should be a slight hill.
So, then the government came along, the central bank came along and said, for the next 3 years, I'm going to guarantee the bond market for 3 years is 0.1. And so they got hammered.
How can they do that? Now, how do they do that?
Well, what they were doing is they basically said, okay, we think the economy's stuffed. We're really worried about COVID. We can't see inflation going up, and part of this is we're going to ensure that the bond market is going to stay at 0.1 for 3 years. How are they doing it? I'll come and buy them.
Right.
Okay, and so I can use money that I print, essentially, to do this.
So they're gaming the system, aren't they?
Well, they were basically coming in to say, hey, we are going to keep bonds really low for a really long time. Now, to be fair, what happened was a couple of years ago, about 18 months ago, the Reserve Bank sort of gave up because everyone else around, the bond traders, are saying, hey, it ain't going to stay at 0.1 forever. You're wrong, and you can't afford just to basically pour money up against the wall. And so if you look at what's been happening recently, the bond traders have been saying, oh no, rates are now going to go to implied, when you look at the bond market, something like, a couple of weeks ago, 4% by the end of the year, now about 3% by the end of the year.
Yeah.
So, you know, they've sort of forced the Reserve Bank by everybody basically saying, well, we're just going to take a position against you. And they forced the Reserve Bank essentially to give up. And so the Reserve Bank gave up, and that caused a lot of credibility.
Why did the Reserve Bank gave up? Because it didn't have enough?
No, it had enough, but it basically said we're just making losses and nobody believes us, and maybe the economy's not as bad as we thought, because as soon as you sort of reopen parts of the economy, it roars back. And the other issue is that when you're looking at more recent times, the bond market look at Australia and say, you guys are just the US lagging 9 months. And look what the US has had to do now in terms of interest rates. And they're assuming that will happen again now. Just at present, economists are basically saying, well, you know, we think you're overdoing it. We do not think Australia is the same as the US. So US doesn't have wage growth under 3, for example. We haven't had the damage that the US had. And yes, we're starting to get some inflation, but you know, we can work out essentially what an interest rate increase will do in terms of it will cost the consumer in terms of what they're paying. And so if interest rates, for example, go from 0.85 to, let's call it 2 to 2.5, on average, when we look at our book, we can say the average household will be paying $300 to $400 a month extra in terms of servicing that loan. Let's look at that, because in terms of mortgages and cash rates, that's a pretty important thing for Australian households. Today, the bond markets are saying that in 3 years' time, that the Reserve Bank cash rate will rise from today's 0.85% to 3.31%. That's today's 3 year. 2 weeks ago, it was 3.9. So they
yes.
do move.
Yes, it has come off sharply. Now, if we convert that through to a 30-year, $1 million home loan, if I look at the margin that, for example, your bank currently charges between a standard variable mortgage and a cash rate, and if I use that margin, that means that the bond markets are saying that the variable mortgage is going to be 6.66% in 3 years' time. And that means an increase in a total interest bill over 30 years from $760,000 to $1.3 million, basically. Now, because you repay your variable mortgage with the interest component and a principal component, you would need a 20% increase in your gross salary just to be able to cope with that monthly interest rate.
And so what the bond market typically overlooks is if you basically increase rates that much, you'll cause a recession.
Yeah.
And that's why economists, well, me, for example, our view would be we would expect the cash rate to get to, let's call it 2.75% sometime next year, no higher. And so that will, in a very simple way to think about it, is if you're an average weekly earner, okay, and you've just had a 4.5% increase, the $300 to $400 you've got to pay back per month more than wipes out the entire
Yep.
increase in your wages.
Yep.
And so I think you need to be really careful, because the other thing that people say, oh, neutral is 2.5 sort of thing
Yep.
for the cash rate. But it's not really, because that assumes everything else is the same.
Yes.
And so, everybody's paying higher petrol, everybody's
Yes.
paying higher electricity.
Yes.
You don't need that.
Yeah.
And the other issue people tend to say is, oh, you've got a lot of savings out there. But if
Yeah.
you take out the top 10 to 15%, there's not much savings at all.
So we're meant to have two, depending upon who you want to listen to and what
Yep.
day of the week, somewhere between $200 and $250 billion worth of savings sitting in all of our bank accounts.
Yep.
But you're saying these average figures are meaningless.
So we look at the cash flow of the consumer.
Yeah.
And okay, maybe they're all NAB customers, but I think they're pretty much the same in the financial accounts.
Yeah.
And what we're saying is most of the savings are held by the top 10 to 15% of the population. And
Yep.
that's always true.
Yeah.
The last official data, unfortunately, is 2019.
Yep.
So you don't sort of get an update. So I would be very cautious. And when we look at, say, the impact of these interest rates, we basically say, okay, in the tails, in other words, at the extremes, there might be
Yep.
someone who's just bought a house, he's got one income, he's under stress, etc., etc. There may be problems. But we don't see the consumer as massively overgeared. So you mentioned, for example, recently in your thing that we're second highest
Yep.
in the world in
Yep.
terms of debt.
Yep.
That's gross debt.
Yep.
So if I add the assets back,
Yep.
we're the second lowest in the world.
Okay.
The big. So they've got 12. They've got about $2 trillion worth of debt, but they've got $12 trillion of assets.
Yep.
So what we sort of look at is we look at the consumer and we say, okay, the consumer, other than in the tails, is basically okay. So the average loan to valuation ratio, people across our book, is something like 40%. So they're not overgeared overall, but there will be tails. The banks are not going to fall over because they've got huge amounts of capital. The problem is the consumer out there hears that house prices are going to fall. They see that their wages are not going to basically go up much, or not as much as they think, and then the Reserve Bank's going to take it away from them. And therefore they're going to panic.
And they'll stop spending.
And they'll stop spending. And so in economics there's such a thing called the paradox of thrift.
Yes.
And the paradox of thrift said, you think it's really good, everybody saves but nobody spends, and therefore the economy falls over. So
Yeah.
it's not actually that good if everyone saves.
No. Right.
So I think really what we're at in current circumstances, the bond market is interesting. We can look at the difference in the yield curves and how, once it starts to look like the long bond is not very much higher than the cash rate. In other words, instead of having that 100 points, you're probably 10, 15, 20 points. That normally, in the past, has signalled a recession within 12 to 18 months. That's what you're already getting in the US. In Australia, you don't get that. You get a big slowing. So growth goes from 4% to 2% because it hurts. But it doesn't look like it's signalling that you're going to have a recession. Why? Because I don't believe the bond market. If the bond market actually was right,
Yes.
and cash rates went to 3 or whatever, or 3.5,
Yes.
I think that would be enough to cause a recession.
Right.
So I think you just need to be a bit careful, because central banks always say, oh, it's not our fault. And I think one of the interesting things recently is in the Federal Reserve, and this has caused a lot of kerfuffles in equity markets, we're basically saying, well, we've got inflation, we've got it away, we've got to do these interest rates, and maybe it's a bit difficult, and maybe we have a probability of a recession. And that suddenly started to change the tone of equity markets. It changed where the bond markets were. It's why the bond markets in Australia went from 3.9 to 3.1 in a week.
Yes.
So you then start to put that in.
So this is probably just a little bit off topic, but it's
Sorry.
on topic. No. All the numbers that we're talking about now, in terms of cash rates, wage increases, variable mortgage rates, if there's any small deviation from them, everybody goes into this massive panic these days.
Okay.
Whereas 20 years ago, 30 years ago, 40 years ago, nobody would have gone into a massive panic. We coped with 17.7% mortgage rates. We coped with 10% unemployment. We coped with a whole range of things. But now it's almost as if we must have a real cash rate. So in other words, the cash rate of the Reserve Bank minus inflation, it must be zero almost.
Well, yeah, and most people say that in a normal circumstance, you should at least have a positive real rate, which is where you get the 2 3/4 or more. And then some people say, well, you need a lot more than that. There's a lot more gearing, and the other issues, people are not necessarily rational, by which I mean what they're saying is, oh, I'm scared, and I will then do my Parex, a thrift problem. And so that...
And pull their horns in.
And pull their horns in. Now, when we look at our book, and we look at everybody else's book to the extent we can in terms of banks, we don't see a liquidity impact until at least next year.
Right.
But we may well start to see a slowing in consumption soon. And it looks like it might have even started to happen now. So, we're just watching there. So it's not a liquidity impact, it's I'm scared impact.
You see, we're in a situation now where we've got the definition, which still amuses me a little bit, of full employment is 4% unemployment.
Yeah, I think it's a bit lower than that, but that's all right.
So we're at 3.8% at the moment.
3.9, yeah.
Okay. So if that was to increase a little bit, and we were to have the technical definition of a recession is 2 consecutive quarters of negative, which I just think is a rubbish. Yeah. It was developed by the head of the Labor Department in the United States, I think a bloke called Siskin, and everybody's grabbed onto this as being a definition of a recession.
Let me give you a really good example of why that's garbage. Okay, so let's assume our economy goes along and quarter number 1 it falls 4%.
Yeah.
Quarter number 2 it goes up 0.1. Quarter number 3 it goes down another 3%. That's not a recession? That's silly.
Yeah.
And so I generally say if you can't grow your economy in a 12-month period,
yeah.
Or the other one they use in the US all the time is if unemployment goes up by more than 0.5% within a year.
Yeah.
That's a recession.
So you think, maybe a little bit old-fashioned like what I think, is that recessions are really about unemployment.
Yes.
and about...
It's about people can't get a job.
Yeah. So do you think we've become all a little bit too precious?
I don't know whether you're too precious, but people get scared. And so they can honestly say, well, how am I going to live? And if most of them are spending as much as what they're currently getting, and they know electricity prices are going to go up, they can see food prices going up, they can see interest rates going up, their sort of response is, well, I'm not going to spend as much. And so we try and look as much as we possibly can to see how consumers are behaving. So we sort of say, where are you going to spend your money? And we see big falls in overseas holidays. We see, I'm not going to do renovations anymore. I'm not going to pay school fees anymore. I'll move in and out. And then the other thing you normally see in a recession is we used to say instead of buying meat, you buy chicken.
Yeah.
But what we also see is people going, they still go out and buy whatever they need, but let's say instead of buying really good dog bones, they might buy really cheap dog food.
Yeah.
And so they switch, and so you need to watch that as well. But at this stage, I think, based on what we see and based on what we think people are going to do, to push the cash rate above 3 soon is asking for trouble. One last comment that's really important on monetary policy. It normally takes at least 6 to 12 months before you see any impact, mainly because it's liquidity, okay? So I would put it to most people that anyone who's looking for an impact from the interest rates that already happen, never happens. You're flying blind. And that's why, as our governor said the other day, that it's a narrow path that they've got to get to try and get inflation down, because there's nothing that interest rates are going to do to get inflation down in the next 6 months. All the monetary policy and increase in interest rates does is it flattens the economy and therefore increases unemployment and therefore people don't get as much wage rises, and therefore inflation comes down. But it takes a long time.
The elastic band.
Well, yeah, and the really good example, and to use that one, we used to, I won't say in NAB, but certainly in Treasury, we used to talk, monetary policy is a rock with a piece of elastic attached to it. And you pull, nothing happens, bang, you get a black eye.
Yeah.
And the example of that was the late 80s, where, there was a really bad crunch in the equity markets in about 88. Then we started putting rates up, kept putting them up, nothing happened. And they just kept going, and they got to about 18, and then bang, crack, the whole economy fell over. So, you do need to be really careful with monetary policy.
So you talk about 88. It seems in economics there always seems to be these areas of immense fear. Yeah. So there's the immense fear of printing money because we're going to end up with the 6-year-old girls taking the wheelbarrows full of money to get the loaf of bread, and the black and white photos from the 1930s.
Yep. In Germany.
Yeah.
Yep.
And the high interest rates. Are we still running economics, mostly from a central bank point of view, on some of these fear factors that we hold off doing something, and then we get quantitative easing, which to me just seems completely, if you're scared of printing money, why would you have quantitative easing?
Yeah. Well, they're trying to basically, quantitative easing was really trying to get the currency down in a lot of ways. But, yes, there's fears out there. The one good thing that is very, very different to what it was in the 90s and the 80s and the 70s is the amount of information we've currently got. So I can remember in Treasury, it was 6 months before we realised we had a recession, and the peak in unemployment was about 18 months after the start of the recession.
Yeah.
Whereas these days, based on the data, so we get real data. So I can see every transaction that goes across NAB's electronic systems on the Wednesday following the Saturday. So I'm about 3 days out of due.
So you know what's going on.
I can actually see it.
Yeah.
And so, when the virus first hit, we could see what was happening to spending in, say, Box Hill. And it was falling 30%. Not at an annualised rate, it was falling 30%.
Yeah.
And so you can see the sort of impact. So you don't necessarily have to worry about, I won't know when this happens. You can actually watch it and see what's happening. So the best thing that we've got now is our weekly data.
Yeah.
And that gives you lots of information. We can also, because we can see what the customer is buying and what he's getting, we can see how many of our customers are being paid the dole within a week.
Right, that's fantastic.
Yeah, and so we give it to the government, we give it to the Bureau of Stats, we give it to the opposition, we give it to everybody.
We compare this to our CPI, where I think every other country.
New Zealand. New Zealand doesn't have a quarter. Yeah. Well.
Our CPI, we get that once every quarter,
yes.
4 times a year.
Yes.
Most other countries get it at least every year.
Get it monthly. No, they get it monthly.
Monthly. So if we've got you've got the NAB giving the government data that it really should be.
Yeah, but what our data, we can't give them the CPI data. Yeah. So if I go out to, Bunnings or whatever, I can see $100 being spent, but I can't see what's actually what they're purchasing.
Yeah.
And what we're trying to do is get that ability. Then we can see what they're doing. But, to be brutally honest, what the Bureau of Stats was sort of said to the government last time they looked at it, well, this will cost us a fortune and we don't have the money.
Yeah.
So you have to say, well, is that good use of your...
Weren't the Bureau of Stats, didn't they have a massive reduction in their budget a few years ago?
They did. Yeah, they did. And you look around and for political reasons they say, well, I'll tell you what, you can get data about mushroom productions in Queensland, you can get data about whisky distillation in these various other states, but you can't get a monthly CPI. Now, I personally think you have to be careful with monthly data. It's very volatile. It can send you bum steers, but it would be useful to know what's in it.
Why did that happen? Why doesn't our government want to have that degree of live data?
Well, they do now. They definitely do now.
Are they going to give them the hundreds of millions of dollars they stripped off them a few years ago?
I've got no idea. I mean, remember, it wasn't that long ago then they were thinking about seriously pulling the census.
Yes.
So, I think that would be a good use of $100 million or something, if that's all it costs to get a monthly CPI. But you do need to be careful. Remember, we used to have a monthly current account deficit. And I can remember when I was in Treasury, I used to think, wow, we're really good at forecasting this. And then what I hadn't realised, they were using our forecast for the actual data, and then about a year and a half later, they get the actual data. And completely different numbers. So you do need to be a bit careful about monthly data because it'll be volatile. And the weekly data you have to be really careful about because you get things like Chinese New Year or Easter that changes.
And
so you've got to try and adjust for it and think about it.
And okay, so you've got currently a governor of the Reserve Bank who is on the back foot, and you think that if you had too much instant data and then there's too much political pressure on what's meant to be an independent central bank, you might get them making too many rapid decisions.
Well, they meet monthly. Most central banks around the world meet every 6 weeks.
Yeah.
So they're more up to date. Look, I think the best thing you can get is you give the central bank the data, as much data as you can, and that makes them less likely to make a fundamental mistake. And, to me, I would go back and say a fundamental mistake would be put a cash rate with a 3 in front of it by the end of this year. That would be a fundamental mistake because you would then get the liquidity impacts, you'd get a lot of people moving off fixed loans into variable loans where you get, below 2% up to over 4%. Now, okay, you've still got a buffer and et cetera, and so you'll be fine. But there will be, you're trying to avoid accidents that if you've got data, you could avoid.
Okay, so at the moment you've got the Reserve Bank talking about the increase in petrol prices, which is really substantial, and electricity and gas, and now groceries are beginning to go up, and they're sort of trying to say, well, inflation may be not quite as bad as we, had first thought or whatever, but then you've still got the bond market. I know it's come off a little bit lately, but you've still got the bond market pitching numbers up there.
Yeah, the bond market, I think, to be fair, if I'm saying where are they getting that idea from? I think a lot of them are saying, well, you're just like the United States of America, except you're 9 months behind them.
Yep.
And, in the States, they were arguing last year that, inflation was temporary, et cetera, and then you get inflation up at 8 or 9%. And then the central bank says, oh, I don't like this. And so I'm going to go aggressively and trying to get it under control. And they may well, as part of that process, because they're going so good. So they're going to be 3.25 by the end of the year. So the next couple of meetings, 75 basis points almost certain is going to happen. And so they're going to take their cash rate from round about our level to 3 and a bit or 3.5 by Christmas. And you sit back and watch.
And the bond traders are saying...
And the bond traders said, well, right. And so what's really strange is you go to the bond traders and they say, in Australia, it's going to be even worse than that. Go figure is my sort of answer.
Well, so, okay, what information do the bond traders think that they have that makes them superior forecasters than the Reserve Bank?
I don't know. And if I can go back through history and give you lots of examples where, back in the 90s they were talking about interest rates getting to 10% plus. Never did. And, there's a wonderful curve where you've got the bond traders against the US actual cash rate, and they're incredibly wrong for 30 years. But, you're still trading these things, and you'd have to say in the last 12 to 18 months, the bond traders have been right, that central banks had to basically start to increase.
Well, Dr. Lowe said, and I quote him here, the financial market has been a better judge than we have over the past few years, so you have to pay attention to them.
Yeah.
I mean, that was almost a capitulation to say, listen to the bond traders and don't listen to me.
Oh, I wouldn't say that far. I'm sure Phil didn't mean that. He'd say that they have been right, that inflation will get away from them. Now, I don't really see there's a lot that you can do with monetary policy to help. Essentially, an inflation shock has come from supply chain issues and basically Ukraine. and the Russian war.
What about, though, the $3.8 billion per week of quantitative easing that was pumped into the economy?
Well, that was just basically trying to keep the cash rate at 0.1, and they sort of blew that up. So, you would argue, and the central bank has argued, that it worked really well, but when they ran up against problems where the market lost faith in them, they hurt their own credibility.
Okay, and so then they can reverse that by quantitative tightening.
Which is what they're doing, by the way.
Yes, which is what they're doing. So that's almost what you're saying is zero-sum game.
Yeah.
In terms of really basically printing money.
Look, QE you can argue there's very close to printing money.
And what they're now is basically burning the money that they printed.
That's right. So and what they're doing is they're essentially, when the bond comes up, rather than reinvesting it, in other words, keeping the rates at the same level, they're letting it mature.
Take it to the fireplace.
Take the fire, so it goes away.
Okay. So one of the methods that the Reserve Bank uses in an attempt not to get to fights where they've got to spend billions of dollars of their money to change the bond market is something called jawboning.
Yeah. We talk a lot.
So tell me about the effectiveness of jawboning and its credibility now compared to maybe 20 or 30 years ago.
Well, jawboning is basically saying to the market, you guys are wrong, or you guys need to listen to us, and if you don't listen to us, we'll use the firepower. And in the past, that's been quite successful. But the problem is, if you've got a credibility issue with the central bank's forecasts, the market might be inclined to say, well, we'll set it out, you can burn some money, and we'll be right and you'll be wrong. And so the jawboning, I don't think, works anywhere near as well as what it used to, because the bank used to be credible. And I think they admit internally that yield curve control, or getting rid of it eventually, in a very undisciplined manner, that they didn't defend it for about a week, which might not sound a lot, but a lot of bond traders lost a lot of money in that week. So they did hurt their credibility, and they've said that. And I think that'll be another issue about credibility. How do you get the Reserve Bank to have more credibility? You have more people on it that know what they're talking about on monetary policy. Don't have any problem with having someone from the unions, for example, on the RBA. You might remember back in the time of Hawke, etc. They had Bill Kelty on the central bank. So you need some people that will basically be able to say, well, guys, I don't believe you because I'm an expert in monetary policy. They've only got one economist sitting on the Reserve Bank board that is independent. So most of the Reserve Bank board outside of the Treasury and the governor are basically industry people.
So the point of the Reserve Bank, of a central bank, for it to work effectively, to give all of the bonds that the sovereign bonds that we're talking about, their value, their risk-free value, is to have an independent central bank.
And we do have one. The question is, do you change its structure a little bit to make it more professional in the sense of you're listening to a number of economists who have expertise in monetary policy who can push back against views. And so I think the central bank is credible, or should be credible, but I think their forecasting record recently has not been great, and that's a problem. So you can get more pushback. You can do like a lot of other central banks around the world. Individual members vote, and that's recorded. So, in the Bank of England, it's 9 love or 5-4.
Yeah.
So 5-4 makes it really tricky.
Yeah.
And, in the Fed, you've got what they call the dots, which is where each of the members on the board puts their forecasts in for what's going to happen then, and they just put a dot, as in it's in the range 2 to 3, 3 to 4 or whatever. Yeah. And that sends some more messages.
Isn't there always going to be a conflict, though, with the central bank and the government of the day between monetary policy and fiscal policy? Fiscal policy being the government basically spending all our taxes to run the country. And so the government goes out there, wants to be re-elected, and therefore goes, right, we need to make everybody happy with us, and so we're going to do something which is going to increase employment, and we're going to run a budget that's a deficit. In other words, an overdraft. In other words, we're going to spend more money than we receive, of which has an effect on inflation, has an inflationary effect.
What's happened in the last couple of years is really the government has tried to make sure that the economy did not fall over. So I don't have a problem with that. My problem is I would like both sides of politics to try and also think about how you might run the economy a bit more productively. So, for example, when the governor talks about, we can maintain 3.5% wage rises but not 5%, what he's really implicitly saying is, let's assume productivity's 1, so I take my wages as 3.5, take away 1, 2.5, that's my band. That's where I want to be. So that's what he's sort of saying. So it would be good. So I don't have a problem with the idea, and I didn't have a problem during the GFC when they started posting cheques. Basically what you're trying to do is keep the economy going. And I think in the medium term, Australia's outlook is really good because we did not get the damage that a lot of other countries had. And we've still got a lot of positives going forward. We've still got our AAA rating. And, you can argue about, so our debt to GDP ratio went from 19 to 40. The world went from 90 to about 110, and the Americans went from 90 to about 130. And the Japanese and the Greeks are 160, and the Japanese are 250. But so relatively we still look pretty good. And I think a lot of people in the medium term will say, provided we get over this and don't have a really bad recession, this is a good place to live, to invest, and all that sort of thing.
So when you say get over this, what you're really talking about is we as a country now are going through a bit of the collywobbles in terms of worrying about fear. And this is the first time that it's happened in 30 years.
Well, a lot of people out there with a mortgage won't have ever seen this guy.
No, they've never been. It's only been onward and upward, and everything's rosy and every day's better, and they don't need to worry about economics because I'm being looked after.
Yep.
But maybe that's stopped and we're back to, I don't want to say reality, but a much wider horizon than we've always had.
And in some ways, you've got to have real interest rates that are positive,
which we don't have.
Well, we don't have, and that what I'm saying is, you need to get rates back up to 2 3/4, but you don't need to do it straight away.
Just slowly
see
and
what
gradually
happens. And if things are okay, then. And the other big positive for Australia is we've got very low levels of unemployment. And so, when you look at bad debts and you try and model bad debts, interest rates matter, economy matters, unemployment is much more important than any of these other ones.
Because in 30 years, there's never really been any unemployment. People haven't felt that fear of losing the job or hanging on, or
Well, you had those high levels of unemployment during the 70s and during the recessions.
Yes.
You got to about 11% unemployment in 91.
Yeah.
So
But still 30 years ago, we're still talking, I still, and I'm quite sure you do, sit with people and they roll their eyes when the conversation comes up about working from home or working via Zoom or whatever, because as people have said to me, Ross, what we need is just a little touch of unemployment and productivity would go through the roof. Everybody would be back into the CBDs of Sydney, Brisbane and Melbourne, and there'd be no discussion by an employee about, I think I'd prefer not to come in on Monday or Friday, because they'd be going, I need to hang on to my job because I've got my mortgage to pay.
That's right.
And we haven't heard that in Australia for 30 years.
No, but you do need to be careful, because that by necessity doesn't mean that the economy goes faster if they all go back in the CBD, because what's happening now is people are spending money out in the suburbs where they live. So what you're going to get is a switch between spending out in the suburbs versus sending money in the CBD. But there's no doubt that in the CBD... So for a statistic that I think is interesting is, post the pandemic, Australian retail is roughly up 26, 27%. In the CBD in Melbourne and Sydney, it's flat. So
Whereas
people,
it's being spent. It's being spent.
it's being spent elsewhere.
Yeah.
And that's why house prices further out, and particularly outside of the bush. So if you're in areas, I don't know, in Geelong and that sort of area, as long as you've got good internet, that's where you spend your money. And that's why house prices in those areas have gone up more than the CBD.
The house price thing is connected to what we were talking about before, the wealth effect. My house has gone up in value and I feel secure and I've got my job and therefore I want to go and spend money and everything's wonderful. If house prices come back, some people have said house prices are going to come back 10, some people have said 20, some people have said more than that. That's going to destroy that wealth effect. People's consumption is going to fall. We would probably go into a recession.
No, because what you're doing is you're just wiping out what you've had the increase in the last 18 months. So let's say we're saying roughly minus 20.
Yes.
In the last 18 months, it's up 22.
Yes.
So what it might do is it might make people feel uneasy, and therefore paradox of thrift comes back.
Right.
And therefore you basically, we basically say growth halves next year as a result of what we're seeing, but we don't see growth going to zero, and we don't see unemployment, with a 5 in front of it. We see something like maybe four-ish, which is good.
Glamour figures.
Yeah.
Aren't they?
Yeah.
Glamour,
So,
you think about 30 years ago.
Oh, yeah.
We're talking about dream economics here, aren't we?
Yeah. So, if you said to the central bank, okay, you're going to have Alan's forecasts, i.e. you're going to have the economy growing at 2% rather than 4%, inflation's going to stay high till 24, but then come back to the roughly where they want it to be, they'd say, that's great, we'll bank that. But, you never know, whether the consumer becomes very thingy, and that becomes an issue.
Do you think the consumer now is more, to use your word, thingy than they were previously? Do you think there's a sensitivity that's so much more heightened now that they can turn the tap off quicker than previous generations?
No, I think they'll still probably do the same. It was always a problem about how the consumer would behave. And so it's still there and we just don't know, but you get bigger swings in house prices now. And so that might have bigger impacts. Basically, you haven't normally lived in a world where food, electricity prices, etc., have gone up. There'll be some people falling over.
Yeah.
And so, people and the government will be saying, I need to lower the fiscal stimulus a bit more. So people will, I think, potentially be a little bit nervous. And we can already see discretionary retail has come off a bit because people are paying for petrol.
Yeah.
And we can see that in our data.
And you would probably expect to see that after they get a few electricity bills and gas bills too.
That's right. And, when we look at the electricity market, we also worry a little bit that the big guys will be fine because they've got contracts. But the small guys in electricity suppliers have to go to the spot market, they're going bust.
Yeah. Okay. Now, in terms of bond traders, you have to do now the Bergonomics test.
Oh, God.
And in looking at these mysterious people that spend $1.6 trillion, which is more than the equity market, and think that they can be interest rate clairvoyants, and they try and shift markets, the effect of what they do in trying affecting interest rate through yields on hamburgers. Good luck.
I've got no idea is the honest answer. What they'll do, I suspect, is that they will basically mean that people won't be as much employed and won't be able to buy as many hamburgers. And so therefore the price of the hamburger might come down. But it's very, let's face it, I just worry that, if the bond market is right and the central banks essentially follow the bond market, I don't think it'll be a pleasant experience for people who want to buy hamburgers.
But you don't think that's going to happen, do you?
I don't think that's going to happen.
No, okay.
No.
A last question. So we've talked about so many topics today.
Mm-hmm.
Where in all of this do you think the Economist is the hero in our story?
Okay, so me, and I'll answer it a different way to the way you've put it. People say, why do you why don't you go off and do masters of economics and econometrics and all that sort of stuff? It's hard. And my answer is the reason I did it is, as an economist, I want my kids to have a job. And if, as an economist, we can help the government not to make big mistakes, keep people employed, I think that's a really good job. And I think there's a lot of social welfare in that.
My thanks to Alan Oster, National Australia Bank's Chief Economist, for being my expert guest on today's Bergonomics podcast. I really enjoyed discussing the rough and tumble of economics with a revered economist who has seen it all: recessions, stagflation, 10% unemployment, and interest rates above 17%. These days, that level of experience is a rare gem. If you have any comments on our discussion, don't hold back. Let's hear them on Twitter, Instagram, LinkedIn or Facebook. My thanks to Ology Creative, the brains behind the design elements of Bergonomics, and Oliver and York, who handle our PR and marketing. We have some fascinating discussions coming up on the Bergonomics podcast. The true economics behind electric vehicles for the Australian market, why many tradies earn more than your GP, and economic and financial terms you hear daily. Your standard of living depends upon them, but you've probably got no idea what they mean. Look forward to you tuning in soon.